Today we're looking at a high-energy analysis report on Plus Therapeutics, ticker PSTV.
A clinical stage pharma stock.
Right. It argues for a strong buy, pitting a 79-cent price against an average analyst target of 7.90.
A massive gap.
It is. And the report does a good job, I think, structuring the argument. You've got the promise, the risks, the technicals, all clearly laid out.
Yeah, a really solid structure. But that structure is also where the first big opportunity for improvement lies.
I agree. Let's start right there with that disconnect in valuation. The analysis really needs to dig deeper into the chasm between that 67-cent price and the almost $8 target.
It's the entire thesis, really.
It is. So right now, the weakness is that the report presents this, incredible 1,000% potential upside as the core idea.
Which is exciting, of course.
Of course. But it treats the severe financial risks. We're talking a $13 million operational loss last year, a tiny market cap. It treats those as, like, isolated factors.
Tucked away in the risks section at the end.
Exactly. And that separation for a stock facing this level of dilution risk, it just weakens the whole argument. The financial weakness isn't a side note.
It's the reason.
It is the reason the stock is trading under $1. But that connection isn't made explicit. It's not articulated.
Okay, I see that. But let me just push back a little on the psychology of it. If you're writing for a strong buy, don't you risk scaring the reader off if you lead with a $13 million loss right at the top?
That's a great point. It's about narrative flow.
Right. You don't want to kill the excitement before you've even built the case.
You don't. And the solution isn't to hide the risk, but to integrate it. Frame it as the reason the opportunity even exists.
Okay, so you lead with the tension?
Precisely. We need to reframe that 67-cent price. It's not just an ugly chart, as the analysis calls it. It's the market's calculated discount for financial risk.
A discount for the probability of dilution.
Or trial failure, given their cash burn rate.
Yeah, that makes sense. If the market truly believed in a clean shot to 7.90, it wouldn't be trading at 67 cents.
Of course not. So the suggestion is to make the price a direct function of that market skepticism.
I like that. So you frame the high analyst targets as assuming two things are successful.
Exactly. Successful clinical trials and successful capital management.
And the 67-cent price shows the market is very, very skeptical about the second part of that equation.
Right. And by stating that tension up front, you change the risk section from a legal disclosure into the central dramatic challenge of the investment.
It raises the stakes, makes it more compelling.
So for a concrete example, you could restructure that opening thesis entirely. Don't wait until the end to talk about risk.
Integrate it from sentence 1.
Yes. You could say something like, the $7.90 target assumes successful trials and capital management. Today's price of 67 cents reflects the market's deep skepticism about the latter, driven by a $13 million annual loss. And that is precisely where the opportunity lies.
That's much stronger. It immediately shows a sophisticated understanding of how these biotech stocks are valued.
It changes the narrative from, this stock is cheap, to, this stock is heavily discounted for a specific, identifiable reason.
And if the upcoming catalyst solves for that reason?
Then you have a clear, logical path to the higher valuation. You've made the risk part of the reward equation.
Okay, that's a powerful shift. So assuming we've established that framework, we need to justify those lofty targets.
We do. And that brings us to the second point. To support the idea that this stock could, as the report says, teleport, the analysis of the core technology, rhenium-186, has to be much more compelling.
The science has to back it up.
It has to. The analysis correctly identifies rhenium-186 as the lead candidate for CNS cancers, specifically glioblastoma. That's all correct. But for a thesis built almost entirely on scientific potential, the description of the tech is, surprisingly superficial.
What does it say?
It just says rhenium-186 is designed to deliver high-dose radiation directly to tumors.
Okay. Which is, what all radiation therapy does.
Exactly. That's my point. It's accurate, but it fails to communicate any unique advantage. What makes this different? Why does this justify 1,000% upside when other therapies don't?
Right. This is aimed at a sophisticated investor, someone who knows how notoriously difficult glioblastoma is to treat.
They know about the blood-brain barrier.
They know the blood-brain barrier limits access. They know that traditional radiation can cause a lot of collateral damage to healthy brain tissue. The analysis has to speak to those specific problems.
Yes, it has to articulate the mechanism of differentiation. The suggestion is to provide a more focused explanation of its strategic advantage. Tell the reader why rhenium-186 is different.
What's the novel approach here?
Is it the delivery method? The isotope itself? You have to move beyond just describing what it does and get into comparing it to what already exists.
So framing it as a solution to a known problem?
Exactly. The report needs to highlight how the rhenium-186 delivery method, for instance, potentially solves a key limitation of current treatments.
Does it bypass the blood-brain barrier more effectively?
Maybe. Or does it allow for a much more localized dose, sparing healthy tissue? Does the isotope's half-life give it a better therapeutic window? These are the kinds of details needed.
You have to anchor that massive upside in a scientific fact.
You have to. Otherwise, that $790 price target just feels arbitrary. It feels like you just pulled a number from an analyst report without understanding the science behind it.
And this is the perfect place to tie in the catalyst. The report mentions an upcoming medical conference presentation.
Right, but it's mentioned almost in passing.
That conference needs to be leveraged as the validation point. It's not just another date on the calendar.
It's the moment of proof.
It is. So a concrete way to phrase it would be to connect the data to the valuation.
How would you structure that?
Something like this. The reason for the $790 price target is the observed success of rhenium-186 in Phase X trials. Specifically, its ability to achieve a localized dose that's unattainable with current treatments. The upcoming medical conference is the market's first look at this data, the proof point needed to shift from speculation to valuation.
I like that. That makes the science the bridge between 67 cents and $790.
It becomes a functional part of the investment thesis.
Okay, excellent. That brings us to our third and final point, the technical setup.
The charts.
The charts. The technical analysis section that defines the support and resistance levels is, I feel, too narrowly focused. It needs more historical context to justify calling a level the line in the sand.
What level are they using?
The analysis leans very heavily on the immediate past. It notes a bounce from 65 cents just yesterday and establishes that as the critical support level.
Based on 1 day of trading?
Based on 1 day. And then it identifies targets at 85 cents and $1. And while I get wanting a tactical setup, the justification just isn't there.
Especially, as the report itself notes, for a stock that has been up in the $20 range before.
Exactly. Defining your absolute floor based on a single day's dip makes the whole analysis feel flimsy, brittle.
That's a huge weakness. With a stock this volatile, recent action is often just noise. The key levels need to be grounded in the stock's actual history.
So the suggestion is to use the low-volume consolidation, which the report correctly identifies, but to explain it better.
Explain why 65 cents matters beyond yesterday.
Yes, how does that 65-cent level interact with previous volume nodes, or long-term psychological floors? The reader needs to believe it's a level where historical buying interest showed up, not just where the selling stopped for a moment.
And the low-volume, low-price environment is exactly what sets the stage for that explosive move on a catalyst.
Right. So the floor has to feel solid. If you're building a case for a rocket launch, you need a very, very strong launch pad.
And I think you also have to connect the breakout levels, the 85 cents, the dollar, directly to volume.
Absolutely. A move on low volume is meaningless here.
You need to state that a breakout requires a massive volume increase to confirm that the catalyst is real and the market is buying into the story. Volume is the confirmation.
So let's give a concrete example of how to frame that 65-cent level with more authority.
Go for it.
Instead of just the recent low, you frame it as the last line of defense before, historical price discovery to the downside.
The point of no return.
Sort of. You could write something like, if the price breaks decisively below 65 cents, this move isn't just a failed bounce. It's capitulation. It's the market validating its deepest fears about trial failure or dilution. This is the last structural floor before long-term historical lows.
That gives the level real weight. It has consequences.
It has teeth. And you can do the same for the upside.
For the 85-cent level?
Yes. Emphasize that a move past it has to come with a huge volume spike. You could say, a break above 85 cents requires institutional conviction. That means we must see volume at least 4 times the current daily average to confirm that the market is officially shifting from pricing in risk to pricing in pipeline success.